$100.65. That's where Brent crude closed on Thursday, the first time above $100 a barrel since before June's ceasefire deal. By Sunday, it was back down to 91. In between, a war that had been contained to one strait for 5 months opened 2 more fronts in a single week, and then just as suddenly it went quiet. Here's what actually happened. MoneySpider, Watching the Financial Web, Episode 3, The Third Front. While all of that was happening, American jobless claims came in at 187,000, the lowest since 1969. Business activity data beat expectations too. The flash composite hit an 8-month high of 53.6. On any other week, that's the headline. It didn't move anything. Odds of a Federal Reserve rate hike in September keep climbing, now up to 82%, because oil, not the jobs market, is what's setting the forward path. Even the odds of a hike at next week's meeting jumped to 38%, though a hold is still the more likely outcome. This is the third week running where the market has effectively told the domestic data calendar to wait its turn. Three big companies reported this week, and all three tell a version of the same story. Alphabet beat on revenue, and its cloud business grew 82%. Genuinely excellent numbers. The stock fell anyway because the company raised its spending plans for the year, up another $15 billion, and its free cash flow went negative. Tesla delivered a record quarter and beat revenue forecasts by 10%. Its stock fell nearly 15% in a single day. Profits missed badly, squeezed by the same rising spending. Intel beat on every headline number. Its price jumped after hours, but then gave back most of that rise within a day on worries about its own capital spending. Three different companies, but one message. Right now, the market doesn't want to hear about growth. It wants to see growth turn into cash. We don't have a fresh sentiment reading this week. The next one lands at the end of July. But we do have the number that will shape it. American petrol prices crossed $4 a gallon again for the first time in over a month. That's not an abstract number. That's what shows up at the pump this week for anyone filling a tank. Iran's government formally suspended its commitments under the ceasefire deal, citing American violations. There is no ceasefire in place right now. With that deal void, the week that followed was the most severe of the war so far. American strikes hit the construction site of a nuclear plant, which is under international safeguards, inspectors confirming no nuclear material was present, and further damaged Iran's only working nuclear plant, though it remains functional. Iran retaliated by striking an Amazon data center in Bahrain for the third confirmed time since March. On Tuesday, the president announces a new rule. For every ship Iran hits in the strait, the US will destroy one Iranian bridge or power plant, including near Tehran. Iran said it would do the same to infrastructure across the region. Then the war stopped being about one strait. Iran's allies in Yemen, the Houthis, attacked 2 Saudi oil tankers in the Red Sea and declared their own blockade on the very detour route Saudi has been using to get around the strait. Separately, over 4 days, drones repeatedly struck an oil terminal in the Black Sea carrying Kazakh crude, a third front in the war that nobody was pricing in. American forces disabled a tanker trying to run the blockade, firing missiles into its smokestack rather than sinking it. And then, after 13 straight nights of American strikes, 2 nights in a row passed with none reported. The Pentagon's own language was about a hold, not over. We don't know yet which way this breaks. The White House met on the same day to discuss the opposite option, a major escalation. Brent crude's move tells the story better than any statement. It opened this stretch near $90, broke 100 on Thursday as the Red Sea front opened, and was back to 91 by Sunday as the strikes paused. That's a $10 round trip in under a week. The market is pricing this war almost night by night now, not month by month. Gold did something worth noting too. For 2 straight weeks we told you gold was staying oddly quiet during an active war. This week it showed up. Gold rose net on the week, ending that 2-week silence. We flagged that as a signal to watch for a third week. Instead it broke. The 10-year Treasury yield in America climbed to its highest level since January 2025, before easing back as oil retreated. Look at what actually moved this week. Fed hike odds elevated, near 82% for September. The 10-year, a fresh 18-month high before easing back. Consumer sentiment, no new reading this week, but one coming soon. Gold quietly higher, ending its own 2-week silence. And Brent crude breaking away from the pack entirely, up to $100 and then back to 91 inside a single week. One line did almost all the work this week, oil, spiking and retreating faster than anything else on this board. Here's this week's signal. The price arm of consumer fracture is now set almost entirely by a war that opened 3 fronts in a single week. The original Strait of Hormuz blockade, a new Houthi blockade in the Red Sea, and drone strikes on a Kazakh crude terminal in the Caspian. Brent crossed 100 for the first time since the now void ceasefire deal, then fell back to 91 as strikes paused after 13 consecutive nights. Petrol crossed $4 a gallon again. Meanwhile, the best jobless claims print since 1969 was almost entirely ignored by markets for a third straight week. We're calling it the third front. Watch 4 things: whether the pause holds, the FOMC decision on the 28th and 29th, the University of Michigan's final July reading on the 31st, and any Senate move on the $95 billion war funding package. We remain calm, we remain curious, and we'll see you next week. We've been working on the website, developing some data to enable us to follow markets, and I'm showing some of the output here. As you can see, the interest bill on US federal debt has gone over $1 trillion, and that's for the financial year 2026 to date. So the most recent data there is on the 30th of June. In the middle, manic Mr. Market, that's the Buffett indicator, showing that the broad market is significantly overvalued. That's not a timing signal, but it is a way of gauging whether the overall market is safe or maybe unsafe. And then on the right, we have one we call the melting anchor, and that shows the value of gold, or the price of gold in dollars, and also shows you how much the dollar purchasing power of gold has disappeared since 1971. So you can only get 1% of the gold that you could have got back then, basically. We're also developing some information on the micro lens of the website. We have a table that we're calling Utopia's 11, which is 11 of the world's largest companies, and also provides an estimate for how much value has maybe disappeared from their peak valuations. In the middle, we've got a Cape Shiller reading of 42 plus. We're calling that Cape Fear. It's at a very, very elevated level. So again, reinforces the Buffett indicator, manic Mr. Market, from the macro lens. And we've also started looking at private credit companies, which look potentially to be the canary in the coal mine for the next market crisis, which feels like it's drifting into view. On the website's Demos page, we've got the University of Michigan reading. So this is a relatively slow moving number, doesn't update that frequently. And we've also been doing some work on trying to gauge how much pressure younger generations are under. We're calling this the generational squeeze index. It's under development. On Polis, we've got a countdown clock on key events. I think the most important at the moment is the midterm elections in America, which is coming up in 99 days. We've also been starting to look at pension legislation changes in the UK because UK finances are under a lot of pressure because of demographic changes. So that's an ongoing project there. On flows, the number in the middle is interesting, showing that over 100% of net fund inflow has been captured by passive funds. So if you're, like MoneySpider, concerned that price discovery seems to be suppressed or under pressure, then the tide table is one way of analyzing where the flows are going. And also on the right there, we've got the dollar-yen rate, because there keeps being speculation that the yen carry trade will unwind at some point. So we're starting to look at that to see, develop an early warning system there. So that's it for this week. MoneySpider watching the financial web. Systems matter, systems leave signals. Until next week, keep watching the web.